Hi everyone, good evening. Welcome to the call for Bharat Bond launch. This is Bharat Bond Tranche 4, which we are launching today. As you all know, Bharat Bond is a program that we all started in 2019 when this government initiated program was started and the mandate was awarded to Edelweiss AMC. Ever since, in the last about 3 years, we have launched 3 series of Bharat Bond, totaling of 5 maturities. This is the 4th tranche where we are launching Bharat Bond 2033 10-year product. In the last 3 years, we have launched about 5 maturity. This is the 6th maturity, and we have raised more than about 50,000 crore overall in the Bharat Bond platform. These Bharat Bond, as you all know, it's a government initiated program where the objective of the program was to get retail HNI corporate participation in the corporate bond market. This was structured in a manner that investors get access to high quality PSU AAA rated bonds. So these Bharat Bond ETF has been structured in a manner that the portfolio is high quality. These are basically target maturity funds where you have predictability of return, you know the maturity date, you have visibility about expenses, you have visibility about the underlying. So basically it provides an investor an opportunity to get into a product where it has very strong visibility of the underlying portfolio, the return and the expenses. To speak more in detail about this whole program and this new launch, we also have today Mr. Dhawal Dalal, CIO Fixed Income. We will structure the launch this event in a manner that I will take a few questions on behalf of all of you, and then I will encourage all of you to post questions in the chat box. Towards the end of the program, I'll take up questions from all the participants. So Dhawal, just to understand on the fixed income space, we are seeing a lot of news around rates going up, inflation peaking out, oil going up and being volatile, Fed raising rates, RBI raising rates. So there is a lot of noise around the fixed income market, and people have been monitoring what is happening on the rate side. So I'll take this opportunity to first take your view on the market. How is the fixed income market placed as of now, and how should the investor interpret this whole noise that is happening around the market? Over to you, Dhawal.
Ranjit, these are very interesting times. As you all know, that the last couple of months we have seen the central banks in the driver's seat, driving policy rates higher and sentiment lower. But now I believe that we have reached a point where a number of market participants believe that the worst of the inflation is behind us. And there are indications and there are some of the economic data supporting that theory, that the worst of the inflation is behind us, unless something unknown happens again. We are going to see inflation peaking out at current level and gradually declining in the next year. Now, along with that, there is a growing expectations that with inflation losing steam, partly because of the commodity prices coming off, or partly because of the supply chains being normalized, partly because of the pandemic related demand push or significant rush in demand waning, partly because of the base effect. With inflation gradually trending lower, there are expectations that now the central banks who have been raising policy rates in a very, very aggressive manner will probably downshift and will start hiking at a gradually lower pace. So for example, in the US, the Federal Reserve was hiking at the pace of 75 basis point per meeting, and for the last 4 consecutive meetings, they have been ratcheting up the Fed fund rate by 75 basis point. Now there are growing expectations that now the inflation softening marginally, and the expectation that the inflation is going to trend lower from here. the market participants believe that the December policy meeting, they will probably hike by 50 basis points. And I think yesterday the Federal Reserve Chairman hinted in that manner as well. And also there is an expectation that from the next policy after December, they will further shift lower. So there has been a significant improvement in sentiment among bond market investors worldwide, which have pushed bond yields lower on the long end. As you know that the US yield curve is inverted, with the spread between 2-year USD yield and the 10-year USD yield is negative to the extent of 70 basis point. And yesterday also there has been a very sharp decline in bond yields, after the Federal Reserve Chairman's comments. So keeping all these factors in mind, there is also an expectations that the upcoming December policy, the Reserve Bank of India will probably, or the Monetary Policy Committee will announce a rate hike of about 35 basis point to take the repo rate to around 6.25, and perhaps remain on a long pause for that until we see some other development taking inflation on a higher side. So with all these things taking place in such a short time period in month of November, there has been a very sharp decline in yields, both in the OIS market as well as in the securities market. And from that perspective, we believe that investing in the current tranche of Bharat Bond ETF, that's a 10-year AAA CPSEs, comes at an opportune time for those who are looking to invest in long-term fixed income, high quality investment for their fixed income allocation. So I think this is coming at a very, very good time. Levels are pretty attractive, and we hope that investors will tremendously benefit from this offering.
Sure. So Dhawal, like I can make out that probably you are with a view that probably we are almost at the peak of the interest rate cycle, few basis points here and there. So in that context, how do you place this whole issuance of Bharat Bond Tranche 4? Can you just take us through this product, the structure, and how has the experience been in the last few years of managing the Bharat Bond?
Sure. So just to take a step back, when we launched the first tranche of Bharat Bond ETF in December 2019, the 10-year yield was closer to about 760, 770. And the fund got invested at a similar level. Subsequent to that, because of the COVID, there has been a very, very sharp decline in bond yields, almost about 100 basis point. So when we launched the second tranche of Bharat Bond ETF that was maturing in July, maturing in April 2031, the levels were about close to 660, 670, about 100 basis point lower. The third tranche that we did for the 10-year Bharat Bond ETF that we did in December 2021, the levels were close to about 685, 690. And now that we are looking to do the fourth tranche, the levels are once again closer to about 7.5%. So in the last 3 years, we have seen a complete reversal of the 10-year AAA CPSE yields. And as you rightly pointed out, that we believe that we are closer to the peak level for the bond market, bond yields as far as the range for the 10-year AAA CPSEs are concerned. We expect the yields to stabilize at the current level as the RBI reaches the policy level of about 6.25 and remain there for a longer period. And from there on, I think gradually one should see a declining bond yields, perhaps in the second half of 2023 or maybe early part of 2024. So from that perspective, I think we believe that investors who invest in the current tranche of Bharat Bond ETF at the current level stand to benefit from the higher accrual as well as potential price appreciation that may take place once the bond yields start declining somewhere in 2023 or 2024.
So Dhawal, what we have also seen in the recent past, this whole target maturity space getting developed. While Bharat Bond started this whole campaign in 2019, Bharat Bond today has become about 50,000 crore plus.
That's correct.
The industry has also kind of launched few similar kind of a product on the index fund platform with different combinations. Those are typically 3 to 5 years. So any reason why you think launching a 10-year at this point in time will suit investors' interest that rather than
Absolutely.
looking at 3 to 5 years?
I think there are two things that we need to keep in mind. That, as you rightly pointed out, that this is a Government of India initiative, right? So the NFO basically caters to the borrowing needs of the CPSEs. That is coming directly from the retail HNI and those investors who are participating in the NFO. Now, keeping that in mind, also we have observed that the supply of AAA rated CPSEs on the long end, that is 7 to 10 year segment, has been significantly lower than the long-term average in the last 2 years. Whereas the demand from high quality investors like insurance, pension funds, and other long only investors remain very, very robust. And as a result of that, we thought that why not bring a 10-year Bharat Bond ETF that will result in increase in the supply of primary bond on the 10-year. That will also help other participants to invest in high quality bonds at the current level. So keeping that demand supply factor in mind, we have been able to convince the participating CPSEs to issue 10-year bond. They were quite reluctant initially because they didn't want to borrow in the 10-year segment, but we have been able to convince them that that's good for the market, good for the investors, and they've been able to convince. So it's a good point to invest, number one. The second point, as you know, that we intend to lengthen the maturity profile of our Bharat Bond ETF program. After the initial issuance of 3-year and then 5-year, we have been consistently issuing 2030, 31, 32, and now 33. The whole idea is to offer longer dated maturities to potential investors so that their tax adjusted and risk adjusted returns are significantly better at the current level. And that also helps them develop a long-term fixed income solution in their portfolio. So these are some of the thought process through which we have introduced a 10-year Bharat Bond ETF. We hope that at the current level, it becomes a very, very attractive solution and investment opportunity for clients. At going forward, we are open to consider either launching a 5-year or maybe even longer dated Bharat Bond ETF if required. I think also, as you mentioned, that there are other players who have also started introducing the index funds in the target maturity structure. And if you look at and analyze their offerings, you will be surprised that now people are looking to offer even 15-year and 20-year or even longer dated target maturity index funds to clients. And that probably highlights the maturity of the clients in terms of understanding of the target maturity bond ETF and index fund structure, and also their appetite for longer dated tax adjusted returns fixed income solution is growing. So I believe that now you are going to see more and more offering on the long end of the yield curve.
Sure, Dhawal. One observation that probably we all have seen in the recent past, ever since the rate of interest have been rising for the last about 2-3 quarters, we have seen that the active bond fund category, which used to exist earlier, I think that category which starts from low duration till about income fund, GSEC fund, we have seen significant amount of outflow from that category. And on the contrary, we have seen this Bharat Bond and similar target maturity funds have been gaining assets. So can you just highlight for everyone's interest, how are these Bharat Bond and similar product different than these active funds, which probably something that people have been able to appreciate and move away from active and get into Bharat Bond kind of a product. So will you just highlight that space a bit?
Sure. So just to put numbers to your observation, as per our data, the actively managed fixed income funds have lost close to about 2 lakh crore in the first 11 months of the calendar year. Whereas the target maturity or the passively managed bond ETF and index funds have seen a net inflow. And this is perhaps one of the largest outflow that has happened from the income fund in the recent time in a given year. And I think it is very, very important to understand why investors are embracing the target maturity bond ETF and index fund structure, whereas they are getting out of the actively managed schemes. And one of the most important thing that comes to my mind is the predictability of returns. As you know that in target maturity bond ETF and index funds, there is experience like a bond investment kind of experience, right? Because in the target maturity, you have a maturity date, and then you have a YTM and on the day of you enter. So keeping in mind the investors believe that they are getting a bond like experience or a fixed deposit like experience, and they know that if they remain invested till the maturity of the product, what kind of returns that they are going to make. Whereas the similar kind of experience is not feasible in an actively managed income funds. If the investor remains invested for say 1 year or 3 year or 5 year or 10 year, it's difficult for them to make a educated guess what kind of returns that they will make at the time of entry of their investment. So this is something that has worked very well for the clients. It's a win-win-win situation in my opinion. Win for the investor because they know what kind of return that they're going to get. Win for the distributor because the client is happy, what they know what they're getting into. And win for the manufacturer because they know that the clients here who are coming, they are coming pretty much with hold to maturity investment view. So this is something that has attracted a lot of attention from clients towards the target maturity bond ETF and index funds. And apart from this, I think some of the other salient features are the expense ratios. I think in most of the bond ETF and index funds, they are typically lower expense ratios as compared to some of the actively managed schemes. And apart from that, the third point is that the investment objective is pretty straightforward. So there are guardrails when it comes to investments in target maturity, bond ETF and index funds, which ensure that and makes it amply clear to the investor that their investments are going to be invested in a particular asset class only and nowhere else. And this kind of assurances bring a lot of confidence, and something like that is not available in the actively managed income fund. So these are some of the features I believe are working very well towards attracting the investors' attention towards target maturity bond ETF and index funds as compared to actively managed schemes.
Sure, thanks. Dhawal, another point that basically crosses our mind that we have seen that these products over a period of time has gained prominence. What we also see that probably these products scoring well over the traditional investments also. So can you just explain a bit how this product, especially target maturity, scores against your traditional product like FD, NCD, or maybe tax-free bonds?
Yeah, that's a very important question, Ranjit. And I think at the heart of this is the mutual fund structure. And perhaps most of the listeners over here will appreciate that mutual funds are the best vehicle when it comes to tax adjusted returns for investors. So what happens is that the as compared to your traditional investments like bonds or fixed deposits, as you mentioned, the coupons are taxable at the marginal tax rate, right? Whereas in mutual fund, what happens is that the underlying investments, although it's in a similar AAA rated CPSE bonds, the annual coupons that we are receiving, they are reinvested in the similar bonds of the similar maturity. So what we are doing is that this is converting your annual interest income into capital appreciation over a longer period. And when an investor remains invested for longer than 3-year period, they're eligible for something called long-term capital gains. And keeping in mind the current inflation profile, we believe that if the average inflation remains 4% over the next 10 years, then investors tends to gain by making significantly higher tax-adjusted returns if they remain invested till the maturity of the product as compared to some of the other traditional investment or even tax-free bonds as a matter of fact. So we have done this analysis, and which is in front of your screen. I think at the current level, the tax-adjusted returns for hold to maturity clients are extremely attractive, and there is no other parallel investment avenue for such high-quality instruments for such tenure, in our view. And this is something that I'm sure clients will appreciate.
Thanks, Dhawal. I think we clearly see a differential of about 200 basis point to 300 basis point getting from these kind of product against any traditional product.
Even if you compare compare that with the tax-free bonds, which are currently trading closer to 5.5%, this Bharat Bond ETF for hold to maturity customer will likely generate additional 100 basis point at least, while the underlying portfolio remains similar AAA rated CPSE names. So there is an incremental return to be made for clients by investing in Bharat Bond ETF, in our view.
Sure. Dhawal, on the fund, now we normally what we understand that this is a target maturity. The fund has a maturity date. Generally, as a strategy, we buy and hold security and all of that. So how do you manage this fund from a flows perspective? So after the NFO, when you get inflows and outflows, so how do you manage the fund from the flows perspective?
See, that's a very interesting, important question, Ranjit. So as you know that the NFO proceeds are invested through a SEBI approved mechanism, wherein the CPSEs issue bonds on the electronic bidding platform, and the Bharat Bond ETF has an assured allocation. So the NFO proceeds are fully tied up. There is no question for us to be able to source these bonds in the secondary market. But subsequent inflows, we have to source these bonds from the secondary market, and for which I think we are successfully able to source some of the bonds. The initial, until we are able to find the right kind of bond from the AAA rated CPSEs, we tend to invest in the underlying government securities, and that way we are able to cover the beta risk of the portfolio. We don't take any kind of cash calls in any of this Bharat Bond ETF or any of our index funds or ETF, other index funds. So the inflows, incremental inflows, are initially invested in government bonds of the similar maturities until the suitable bonds are sourced from the secondary market. Now, when it comes to the redemption, in case if we receive the redemption, what we do is that the first thing that we liquidate is our liquidity buffer that is being maintained in form of government bonds. And as you can see, the asset allocation, the fund has can maintain up to 5% of the portfolio in government bonds. So that first 5% of the redemptions of the scheme is met by liquidating the government bonds. And if there are more redemptions, then we will tend to liquidate bonds wherein we are overweight as compared to the underlying index. That way, our fund exposures will come very, very close to the index weight. And this methodology has worked very well for the last 3 years in terms of managing our inflows and outflows from Bharat Bond ETF.
Sure. I will also request participant to put their question in the chat box. We will post a couple of other questions. I think we will take up these questions from participant. Dhawal, on the fund side, like we know, this is Bharat Bond ETF. ETFs are held in demat form. We have also simultaneously opened the fund of fund structure. So can you just quickly highlight how does fund of fund works? So how does for which category or segment of investor it is good for them to consider fund of fund?
Yeah. So as you know, the ETFs are normally traded on the exchange, right? And the ETFs are traded at the continuous price from 9:30 to 3:30. And any investor who wishes to buy or sell these units can do so on the exchange. While that may be true, there are a number of investors who feel that they are not able to or not comfortable buying or selling units on the stock exchanges. And for them, I think the fund of fund becomes a very, very suitable investment vehicle to invest in the Bharat Bond ETF. For each Bharat Bond ETF that we have launched so far, there is a dedicated fund of fund which fits directly into the same Bharat Bond. So for example, in case of Bharat Bond ETF April 2033, there is a dedicated Bharat Bond fund of fund April 2033 who will only invest in the underlying units of the Bharat Bond ETF April 2033. So what happens is that when the investors invest in the fund of fund, which is similar to like investing in any other actively managed funds, we receive the inflows, and the inflows are collated, and then fund of fund becomes one of the investors in the Bharat Bond ETF. So these then ETF then in turn invest this money in suitable assets. So what happens is that then in that method, the investors don't have to source these units of Bharat Bond on the stock exchanges. The expense ratio for fund of fund is very, very low as compared to some of the, it's only 5 basis point, I believe, right? As compared to, and it's even lower than investing in a liquid fund in some cases. So it's a very, very attractive vehicle for that. The valuation of the fund of fund unit is based on the last traded unit on the stock exchange. So investors will get similar experience of investing on the stock exchange for the underlying Bharat Bond ETF. And when they want to redeem, the redemption, they can redeem from the fund of fund, and there is no lock-in after initial period. And after that, investors can get their money in due course in their bank account.
Great, Dhawal. So on the so we have basically talked about all the benefits, features, and highlight why an investor should actually consider Bharat Bond. If you can also let us know, Dhawal, is there any risk involved in this? I think that is one of the important.
Well, yes, absolutely. We must talk about the risk when we talk about the returns, right, or investment. So I believe that there are two important risks that investors should be cognizant of. Number one is the premature redemption. So we believe that this investment works very well when it's being made with a view to remain invested till the maturity of the product. In case if the investors are compelled to redeem in between, then they are exposed to the market level risk. And this is something that investors need to be cognizant of. The underlying portfolio is getting marked to market on daily basis. So in case when the investors have to redeem at some point of time in between premature redemption, then whatever is the underlying NAV, they are going to redeem at the underlying NAV. And in a case of rising interest rate, that NAV could be lower. In case of a declining interest rate, that NAV could be slightly higher. So this is something that we must be cognizant of. The other risk is something that investors should keep in mind, that these assets are marked to market on daily basis, and investment horizon of investment is very, very important. The investors who are looking for a 10-year solution should only consider investing in this Bharat Bond ETF April 2033. And what I'm trying to say is that the investors should match their investment horizon with the underlying residual maturity of the product. An investor who's looking for a 5-year solution ideally should not invest in a 10-year Bharat Bond ETF or a 10-year any kind of index fund, because that poses a similar kind of risk that when they need their money back, then they're exposed to the market level. So these are some of the risks that clients should probably be cognizant of before investing.
Great. So meaning one should try and basically match the maturity with the investment horizon and then accordingly plan.
Yeah.
Great, Dhawal. I think we have also started getting questions. So we will start taking few questions and then.
Absolutely.
Yeah. So one question that I can see, Dhawal, it says that what type of reinvestment risk you associate with this product?
So that's an important question, and thanks for asking. As you know that these are corporate bonds and they pay coupon every year, right? So at the end of the first year, we are going to get coupon, and this coupon will be reinvested in a 9-year bonds. Similarly, end of second year, when we get another coupon, then the coupon proceeds will be reinvested in an 8-year bonds, and so on and so forth. Now, when we make the investments of these coupons into this, the bonds of residual maturity, these investments are being made at the market level available at that point of time, which we don't know whether it's going to be higher or lower. We believe that in a rising interest rate scenario or a stable interest rate scenario, this reinvestment happens pretty much at the similar level when the bond was purchased. In some exceptional cases when there are significant decline in bond yields, then the reinvestments do happen at a lower yield. And based on all these factors keeping in mind, we believe that the total return, that is return taking into account through the reinvestment of this coupon, could be in the vicinity of about 5 to 10 basis point from the initial investment level in terms of YTM. So yes, there is a reinvestment risk of the coupon, and this is in the range of about 5 to 10 basis point based on our calculations. But even keeping that in mind, the end result is extremely lucrative for clients, in our opinion.
Great, Dhawal. Another question is, how is the taxation impact if someone chooses to get out before maturity?
Yeah, so that's also a very, very important question, and thanks for asking. As I mentioned, that the Bharat Bond ETF has a similar taxation as compared to the mutual funds, and wherein the long-term capital gains are applicable from investments of minimum investments of 3 years. That means if an investor remains invested for at least 3 years, then the long-term capital gains are applicable along with indexation. And that generates a very, very attractive tax-adjusted return for clients, because in the current environment, the inflation has remained slightly higher, and a higher inflation tends to reduce the taxable amount for investors. Whereas anybody who is looking to redeem in less than 3 years, then they have to pay taxes on the marginal tax rate on the capital gain.
Great. So anything above three year, there is no impact on tax. You continue to get long-term capital gains
with indexation. With indexation.
Before 3 year, you might have to pay. You will have to pay
marginal tax.
Marginal tax rate. There's another question, Dhawal. Are you not planning to target a fund of 25 years so that a retiree can use it for income without?
I will be very, very happy to consider in launching a longer dated Bharat Bond ETF at some point of time. Currently, there are a number of CPSEs who have envisaged interest in launching longer dated funds, longer dated assets to Bharat Bond ETF. As per the SEBI regulation, we need minimum 8 issuers to agree to issue us bonds of longer dated maturity. So the moment we have a minimum 8 issuers who are looking to issue bonds of 15-year or even longer, absolutely we'll be thrilled to launch a longer dated Bharat Bond ETF for clients.
Well, another question is, how do we calculate the IRR on a regular day-to-day basis?
Well,
first, I think, is it a product where one should actually track the performance so closely and so in such a short period of time?
See, ideally, this daily returns, calculation of daily returns is something that most of the AMCs do. But the investors and partners are well advised not to look at them on day-to-day basis, because these kind of investments are to be made for longer dated asset allocation for clients' portfolios, and they tend to start showing results after 1 or 2 years of investments. And that will also take into account some amount of volatility in the market. So there are a number of websites like Value Research where you could probably see the performance of the fund, the index, as well as how some of the peers have done in a similar maturity bucket. So yes, there are options available, but I would urge investors and partners to let their investment season for some time, maybe 1 or 2 years before looking at it, because I believe most of the investors are coming in this category for at least 3 years, right? There is no reason, in my view, to look at things before 3 years, because then you will get tempted to do something that ideally shouldn't be done. Only after 3 years, you should periodically check the return. But best strategy, in my view, is to hold to maturity in order to reap very juicy returns from the investment in this kind of products.
I think the strategy should be similar to what we follow in IFD. We invest and we forget.
That's correct. You don't forget, but you know that you have invested. You'll get the money back.
Sure. Well, there's a question on ETF and FOF. Is there any difference in YTM for ETF and FOF?
So yes and no. As you know, the fund of fund typically is an investor in the ETF itself. So to the extent of the expense ratio of the fund of fund, the YTM of the fund of fund will be slightly different. Now, there is also a new valuation policy that has been introduced by SEBI, wherein the fund of fund will have to take their valuation from the last traded price on the exchange for the underlying ETF trade. So what that means is that there will be a marginal difference between the end of the day NAV based on which the YTM of the ETF is calculated and the last traded price on the exchange. I remember that exchange closes at 3:30, right? Whereas the end of the day NAV is being calculated at 5 o'clock. So what happens between 3:30 and 5? There could be implication on the end of the day NAV. So keeping those variations in mind, there will be a marginal difference in the YTM over and above the 5 basis point expense that the fund of fund charges.
Sure. Well, there are a lot of questions around market view and rates and all. I'll just sum it up. So what is your view on repo rates? How is it going? How RBI is going to raise it now? How is the interest rate going to reverse, and to what extent it will settle down? Something around this level.
Yeah. So currently we are at 590 at the repo rate, right? And now the MPC is meeting next week, 5th, 6th, and 7th. And we believe that the MPC is most likely to come out with a 35 basis point increase, which will take the repo rate to 6/4. Now, the market participants believed that the terminal policy rate, or the level at which policy rate will stabilize, was about 6.5%. But now with whatever has happened in month of November in the US, and which resulted in a bond yields declining, there has been some amount of scale back in the expectations of terminal repo rate, which is now stabilizing at around 6/4. So we believe that the repo rate will stabilize between 6/4 to 6.5. I think the Reserve Bank of India is going to remain on pause for a longer period in the calendar 2023. And maybe we will see some amount of downward adjustment in the repo rate, perhaps in calendar 24, depending on what happens in the global markets. So I believe that these are the market expectations with regards to the repo rate. Now, if the policy rates have to stabilize between 6/4 to 6.5%, we believe that based on the long-term average, the 10-year yield in India will also stabilize between 7 to 7/4, which is about 75 to 100 basis point range over and above repo rate. So these are the broad expectations with regards to the 10-year. And now, obviously, the yield of the 10-year will also be determined based on certain other factors like demand and supply, in price of the crude oil and inflation and other factors. So broadly, we believe that the 10-year will stabilize between 7 to 7 quarter 730 over a longer period. And these are our expectations for the next couple of months.
Great. So there's a question around SWP. Can we plan SWP from Bharat Bond?
Of course, I mean, there is no lock-in, right? So once your investors achieve a long-term capital gain tenure, I believe that investors can consider looking at different kind of things for their clients, depending on the need for funding.
Yeah. So once the investment completes 3 years and you cross long-term capital gains, that is where probably you can set the SWP at certain percentage, which can be below the desired return.
That's correct.
Yeah. Dhawal, yields have gone down in the last few days.
Yes.
Few weeks, but last few days. Do you expect any impact on the same for the Bharat Bond 33 yield?
Well, I think we are all part of markets. So whatever happens in the market will have an impact not only on Bharat Bond ETF 2033, but also for the existing Bharat Bond ETFs as well. I think one of the biggest thing that we are watching is the Monetary Policy Committee meeting, right? And wherein we are hoping that it will be less disruptive and it will be a dovish rate hike. So from that perspective, I think yield should remain stable at the current level in our view, because right now, the way whatever is happening in US market and Indian market, I think the market is slightly ahead in terms of their expectations. And we should expect some amount of pullback in bond yields between now and the policy.
Probably that's the reason we decided to close the NFO after the RBI policy.
That's correct.
So that the deployment is post the policy and it
That's
takes
correct.
care of any impact on the yield on a higher side. Now, there's a question on REC and PFC. Them lending money to SCBs. Are you seeing the SCBs not treating them? So are these delays in payment from? So something on the REC PFC lending to the SCBs. So are you seeing that as a standard asset? Things are all going well there on the public sector side?
No, I think the government of India is cognizant of the delay from the payment from the SCBs to some of the power sector companies and like NTPC, who are the power producer, and to the other entities. However, we believe that their payment to REC and PFC continues to remain on track. I think the government of India ensures that there is no delay in payment. So from that perspective, we are not worried at this point of time with regards to REC and PFC's exposure.
Sure. On the investment side, is it one time or SIP mode suitable for investor? What is your advice?
I believe that SIP model has been successfully tested in equity markets. Now it's time to test it in the fixed income market as well. I believe that generally Indian investors are not using SIP for investing in fixed income funds. And I think the Bharat Bond ETF provides this platform wherein clients can consider doing an SIP for longer period. So obviously, I think it's a good option to consider for clients in case if they can't make a lump sum investment in Bharat Bond.
Well, on the yield side, what is the expectation that one can have with this NFO? What kind of a yield one can expect?
Well, it's difficult for me to answer given the current mechanism and the current event that are in front of us. But we are hopeful that the yields will be similar or closer to the index level, which is what we have in front of us before the closure of the NFO.
Sure. I think there are questions which are getting repeated. One question is, I think this has been answered. When one does a premature redemption, does the ETF have to sell bonds? Yes, ETF has to sell bond, and
if we don't have sufficient amount of GSEC. We normally maintain a layer of liquidity by investing in government bonds. Our existing Bharat Bond ETFs have also have exposure to government bonds, and our portfolios are there on our website. For anybody who wishes to look at our portfolios, everything is transparently available on our website.
Great. I think we have had a lot of questions, Dhawal. I think we have covered mostly all of them, and it has been very, very widespread. One last question, I think I'll take this. Is it who are suitable for the above fund? Which are the right category of investor who should look at Bharat Bond product?
Well, again, as I mentioned, that those who anybody, retail, HNI, family office, corporates, anyone who's looking for a very attractive, high quality, tax adjusted return from a 10-year investment horizon is most welcome to invest in Bharat Bond ETF. And I'm sure that they will have a very, very good experience. As I mentioned, there is no other similar attractive investment opportunity at this point of time in the market. And from that perspective, I think it's second to none. And I think investors will probably realize this and will embrace it wholeheartedly. So we look forward to a very, very strong and solid support from our partners and investors like what we have seen in the past.
Great. I think I'll take one last question, Dhawal, and then we will wind up. So this question is around market making. It says that once it is listed, the price on the website, the price on the exchange, there's a gap. So is the market maker doing anything to reduce this difference, which is there?
So I think what we are observing is that most of the time, the units of the Bharat Bond ETF are trading at a premium to the underlying NAV. Now, there are multiple reasons for this. The number one is that obviously there is a very, very strong demand from clients to invest in Bharat Bond ETF. Those who have not been able to do so in the NFO, they are looking to buy on the exchange. So this is something that we have observed, and I think if anybody of you who have been in the market for long enough, long ago, there used to be a fund called Morgan Stanley Growth Fund, and there used to be tremendous demand from clients to invest in Morgan Stanley Growth Fund, and whenever there is a demand outstripping supply, the ETF or any other product has a tendency to trade at a premium for that. And now there are market makers who are providing liquidity at current level, and these market makers have been instructed to quote narrow two-way quotes, so as per their agreement. So it is our constant endeavor to keep providing liquidity on the exchange for our clients, and two-way quotes, continuous two-way quotes, so that not only on the offer side but also on the bid side, in case if anybody wants to sell. And we'll keep ensuring that the bid offer spreads will get narrower. Now, this market making mechanism is evolving as far as the bond market is concerned. And I think at this point of time, there are limited market makers. We believe that as more and more market pay makers are joining this movement, and it will ultimately result in narrowing of two-way spreads. So I'm not going to be surprised if by the end of next year, when we have more and more people doing market making operations, this bid-ask spreads will continue to narrow. And this is something that we have observed in terms of development of bond ETF and ETF, other products in global markets. And I'm sure that the same thing will happen in India also at some point of time. I think it's going to happen faster than anybody's anticipating. So we'll be very, very keen to introduce more market makers in this process, and they in turn will help narrowing two-way quotes for clients.
Great. I think we had a lot of questions. A lot of questions were kind of asked from seasoned investor, and I think very, very relevant. Probably some of the questions that we missed out. Yes, so I think we have covered most part of it, Dhawal. We are also on time, so we are touching 5 now. Any closing comment from you, and then we will wind it up?
I think I would like to thank each and every one for joining us on this call and asking us questions. We are very, very thankful for you and our partners for making this product a very, very great success. From our perspective, we truly believe in the potential of this product. As I mentioned, that it's one of the cheapest bond ETF in the world. And it's coming at a time where we believe that yields are closer to the peak. And I'm sure that investors will have a great experience investing in this product at current level. And we look forward to a wholehearted support from each and every of our clients and partners in this NFO. Thank you.
Great. Thank you, participant. I think it was a great set of questions asked by all of you. So the NFO starts today, closes on 8th, next day to the RBI policy. We expect to close this NFO on a high, like our earlier tranches, where we have on an average raised about 5,000 to 7,000 crore in every maturity. Today, the Bharat Bond program is about 50,000 crore plus. Hope we all are able to make this a big success this time around. Thank you, everyone.
Thank you.
Thank you for joining.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.